Do you feel like saving money is nearly impossible given your current income? While saving money is much simpler when you're earning a lot of money, it is still entirely possible to save money on a low income. In this video, I'll share with you 5 simple ways to increase how much money you save each month, regardless of your income. Number 1, reduce your housing costs. Regardless of whether you rent or own, the cost of your housing will be your biggest monthly expense. According to many financial experts, the sum of your rent, mortgage, and other bills shouldn't take up more than 35% of your gross monthly income after taxes. However, even though this expense consumes a large portion of your income, it also presents the biggest opportunity for cost savings, allowing you to save money even if you have a very low income. Now I want to address this issue. I still live, but perhaps you could make do with a single room in a house or a studio apartment instead of your current 2-bedroom arrangement. I know it may seem like making this change would be quite dramatic, but the savings can also be quite dramatic. For example, the average 2-bedroom apartment in the US rents for about $1,100 per month, while the studio apartment is around $950. That's a savings of $150, and that doesn't even take into account the savings you would realize paying less utilities when renting a smaller place. However, if you have no desire to move, it may not be a good idea. When I used to rent, I exchanged tax advice and monthly bookkeeping services to offset some of my costs, such as completing renovations in exchange for a rent decrease or agreeing to sign a lengthy release of the tenant security at your landlord desires. If you're a homeowner, then this advice is a little lot different. Well, you probably don't want to move out to save money even. Small things like turning off the lights, a simple swap of goods and services saved me thousands of dollars over the course of my lease, allowing me to save money while earning an extremely low income. You may save a lot of money by cutting back on your water use. The greatest approach to eventually offset your housing costs is to rent out a room in your house. This can easily bring in an extra few $100s each month to assist you pay your bills, allowing you to have more money in your piggy bank at the end of the month. But if you don't have an extra room you can rent out to cover your housing bills, the next way you can reduce your monthly costs is by paying down your mortgage. Listed below are a few ways to lower your mortgage costs and begin saving yourself a ton of money. First, switch to bi-weekly mortgage payments rather than monthly ones. For example, if you make your standard monthly mortgage payment on the first of every month, that equals 12 mortgage payments per year, with 52 weeks in a year equaling half your monthly payment. Bi-weekly payments can total up to 26 installments or 13 full payments annually. I began doing this the moment I realized how much interest you can save by switching to bi-weekly payments. To further illustrate, let's say you have a $300,000 mortgage with a 3% interest rate for 30 years. If you make monthly payments over the course of that time, you'll end up paying about $150,000 in interest. However, if you were to switch to bi-weekly payments instead, your total interest cost would be $210,000. If you'd like to have an extra $25,000 in your pocket right now, please let me know by generally tapping that like button below. Another way to lower your monthly mortgage costs is to refinance your mortgage when mortgage interest rates decline. This involves shortening the term of your mortgage and paying less in interest. To give you another example, keep in mind that there are costs and fees associated with refinancing, so you have to do some math to determine whether the savings and interest will make it worthwhile for you to do so. But as you can see, the savings and refinancing are related. For example, if you had a mortgage of $250,000 and were able to reduce your mortgage from 3% down to just 2.5%, you would save approximately $25,000 in interest over the lifetime of your loan. Avoiding debt at all costs will help you save money even if your salary is lower than you'd like, since debt prevents you from saving in 2 ways. Since debt is almost always associated with monthly interest charges for lines of credit, these rates are typically between 3 and 5%, meaning that on a $10,000 balance, you'll be handing over around $25 to $40 a month. Well, it seems like a small amount, but having debt means monthly repayments every month. Creditors will be knocking at your door for money, which, if that debt was avoided, would mean more money in your pocket a month. You can understand how it could be difficult to save on a modest income if you have debt. When it comes to credit card debt, the problem is only made worse because the average credit card interest rate is 20.47, which means that getting into debt is an expensive process. To put this into perspective, if you have a balance of $6,348 on your card, you're paying about $1,300 in fees to the credit card companies. As a result, if you want to save money on a very low income, you should avoid using credit cards. The third tip is to learn how to have fun on a budget. We all want to have fun, but for many individuals, it comes at a significant expense. However, it doesn't have to. When I was younger, my main source of entertainment was going up to the club with my friends, but sadly, most nights were very expensive between cabin 2 and from the bar buying drinks and paying cover most nights randomly $100 easily. As they grew older, my focus shifted towards increasing my wealth and becoming more comfortable. Number 4. When you're on a low income and want to save money, you need to be able to distinguish between your wants and needs. For example, you may want to upgrade your phone to the newest model but probably don't need to. You may also want to buy a new shirt to wear out this Friday, but you probably already own plenty of good shirts. Spending money without a doubt makes us feel good, perhaps even as good as you know you're clicking that subscribe button below. I like to categorize anything that pertains to my survival as a need. These include necessities like food, clothing, shelter, and transportation in the most basic sense. Purchasing a Ferrari is transportation, yes, but only in the most basic sense. You can also travel from point A to point B by bus. Wine products are essentially anything that doesn't fit into your needs category. This includes anything that is an enhancement to items you already own, such as upgrading your phone to a new model in order to get a camera with an additional 2 megapixels. However, I realize that these definitions of wants and needs are ambiguous, so let me share with you a tested model derived from Boston Consulting Group's Gross Share. Use a matrix to clearly see where your priorities are so that you may use that information to make better decisions. Make a 4-quadrant score and assign each of them the following names: urgent need, pressing desires, low priority issues, and low priority issues. Once it is finished, start placing the items you want to buy into these boxes. This will help you determine where you think these purchases should fall, allowing you to consider how urgent or important some of these items are. Of course, you don't have to keep your spending to a minimum forever, so if you want to learn more about this, do so. Here's a general suggestion for one thing. The technique is great for 2 reasons. First, it helps you develop the habit of setting financial goals, and second, it gives you time to consider how badly you want the item. It's common that people who buy things on impulse end up experiencing buyer's syndrome or more shortly after. So if you want to make sure you save, set a financial goal you want to achieve, like saving $1,000. Only once you've reached this goal, you can go ahead and buy the item you've been wanting. Automate your savings is the 5th step. Automating your savings is the last step to make sure you can save money despite having a modest salary. One of the best things I've ever done for my finances was to set up automatic deductions for my paycheck with my employer. Basically, these deductions let me send a portion of my pay directly into a savings account rather than my checking account. When I first set up this process, it allocated 10% of my after-tax income to my savings account, but over time, I discovered I could increase this to 20% and double my monthly savings. When compared to automatic withdrawals from various accounts, persons who spend as little as 1 hour visualizing their goals see an average rise of 73 after just 1 month. When you think about it, this makes perfect sense. Essentially, you are being much more deliberate with your spending, which is why I previously mentioned that defining your wants and needs is crucial when trying to save money on a very low income. Now, I believe the savings technique has been so successful for 2 other reasons. First, it allowed me to pinpoint exactly how much I wanted to save, making reaching my financial goals 10 times easier. Second, it took the thought of having to save off my mind substantially. I hope you enjoyed this video and make sure to like, subscribe, and turn on bell notification for more content like this.